Welcome to the Energy Resources and Environment Special Lecture Series. We are so happy to have Alana Fishman with us today. Not only is she an expert in ESG, and that's what she will be talking on today, the industry ESG evolution, she's also a SICE grad. And so that makes her very near and dear to our heart. So before coming to SICE, Alana went to Miami University, and she's had a strong interest in environment for many years. She did political science and environmental practices. Then she went on to IHS Markit. She was a program manager there. She's had a varied career. She's worked at Newmont Mining and helped them try and become a little bit more environmental. So all these different careers or career steps have led her to where she is now as Vice President of Government Affairs at Cornerstone. And I'm going to read this, where, okay, no, I can't even find it. You went through this with me at orientation too. I can't read, I should just say. In fact, I'll just turn it over. She can tell you what she does. She works with clients, many different clients, to spread the gospel of ESG and to take it to the next level. So she's going to speak to us for about a half an hour, 45 minutes, and she is more than welcome to have a big discussion with you all on this new and emerging industry. So please join me in giving a big welcome to Alana Fishman.
Thank you. Well, it's awesome to be here. Thank you. It was a perfect introduction. So just to kind of go a little bit into my firm, I work for Cornerstone Government Affairs. It is a government relations lobbying firm based out of Washington, D.C., and you guys are probably wondering why an ESG person is lodged within a lobbying firm. That surprised me as well. When they first found ESG and asked me to come on board, it didn't seem like an obvious fit to work in a lobbying firm for advisory services in ESG. What I do for the company is I lead their consulting practice for sustainability and ESG. And the reason why that's unique is because as a lobbying firm, they have clients across industry verticals, whether it be healthcare, real estate, oh my God, I'm gonna draw a blank now, but it's like all the verticals, energy, utilities, any vertical you can imagine, we have clients in those verticals. And each of those clients are now trying to figure out how to operate in the space of ESG. And so I come in and partner with our existing clients and have them figure out what are they already doing in the space of sustainability, how does it pivot to ESG, and what can we help them manage. So that's my day in and day out job. I'm very comfortable in energy and extractives with my background at Newmont Mining. I quickly had to learn about how this applies to tech firms, how it applies to airlines, how it applies to healthcare and defense. Real estate, you name it. I probably have looked at rodeo, you'd be surprised, is interested in ESG. We figured that out a little bit a while ago, so it's all, everybody's moving in the space where we're discussing it. So I'm actually giving you a mixer presentation that I gave, actually you were doing, you're speaking at Reuters event, and so I did a similar presentation for a company, for different companies and groups at a Reuters event in San Diego, and the presentation I'm doing is what is ESG and how it links to social, corporate, and regulatory value. I'm going to pause for a minute and say, who in this room has heard about ESG? Okay, good. That's a lot more than usually who I speak to. Does anybody know the difference between sustainability and ESG?
Take my class.
Do you think it's the same? There's no wrong answer. This is just to get a feel for what we're going to go into. Is it the same?
ESG is broader than the other.
Switch. Sustainability is much broader than ESG.
Yeah, but ESG is environment, sustainability, and governance, isn't it?
Environmental social governance. So very broad categories that have essentially started to link financial value to sustainability indicators. So if you think of sustainability like an umbrella, ESG is like a spoke in that umbrella, where it's very specifically tying what is financially material and relevant to companies in their own verticals under that sustainability wing. Does that make sense so far? So it's very, very specific, and that's the difference. And so we'll get right into it because I do a level setting slide. This is about my firm, but we talked about that. So whenever I always start with the level setting, just because sustainability and ESG are constantly used, back and forth, and there's a big difference. And one of the biggest reasons companies had a little bit of a slower start getting into the ESG realm is because they already assumed they were doing sustainability work. And we already have a corporate social responsibility department. We're doing great. We don't need to worry about this stuff. ESG is different. So you can look at words like sustainability, CSR, impact investing. Those are all words that are very similar in the framework of CSR and sustainability, but ESG, from the way Cornerstone supports our clients, is what is the most financially material sustainability metrics that can impact the long-term value of your company. So if you don't care about environmental issues, social issues, and governance issues just on your own as a firm, you should care about your bottom line, and you should care about your profitability, and you should care about making your shareholders happy. That's what ESG is, and that is the biggest difference as to what we do for our clients across the board. What I like to talk about with clients now, it's no longer a question if companies should interact in this space, it's just a matter of how they're going to choose to interact in this space. There's a term that we not so lovingly use called greenwashing. It's very, very common. And what happens is ESG is such a hot topic, buzzword right now. Companies will have taken their CSR reports on their website, hit a find replace sustainability with ESG. They just change out the words. So now all of a sudden those big data algorithms are picking up that companies are including ESG in their websites, and they've done nothing to modify their processes or actually manage the risk that goes beyond ESG. Those companies are quickly being found out and called out by investors, and capital is being shifted away from them because they can tell the difference now if you're not actually making the effort. So now what companies are seeing is, I actually have to do something in this field. What do I do? Not everybody is a Microsoft, not everybody is a United Airlines, not everybody has endless financial and human capital to put towards this stuff. So what do you do to target what's best for your firm with the resources you have? And that's the how companies can figure this out. So there are two driving forces for why ESG is there's no opt-out clause anymore. And the driving forces are the internal benefits that come with ESG. And I'll show you a slide shortly to tie what ESG means. But the internal benefits are, as we were discussing, you can link environmental, social, and governance indicators to financial value, cost of revenue, cost of capital, any risk, anything like that. So if you can figure out what ties to your cash flow, that can impact your bottom line, right? That's what companies care about. That's what they want to pay dividends to their shareholders. So you want to figure out if you're going to be impacting your financial value. Idiosyncratic risk, who here is taking corporate finance? Sorry, me too, I know. But it's a great class, but you should take it. You can diversify away idiosyncratic risk, and you should as a company. You don't want your company to flop because you could have managed your risk better. That's idiosyncratic risk. ESG helps to manage that risk. It's not market-based, it's your own corporate risk. And then your valuation. If you are less risky as a company, your cost of capital, corporate finance people, should decrease because you are less risky. So when you divide by a smaller number, when you're doing your present value calculations, you have a higher value in the market. So that's what companies are going for here, and that's what ESG drives. So when we go in with clients and we talk to them, I will never say to them, what you should do is build a bike share program because that'll make everybody so super happy. I will never say that. I will say, dear oil and gas company, you really need to go figure out where your methane is leaking, because if you get any kind of regulatory cost put upon you, that's going to cost you millions, if not billions, depending. You can get fined. You can, if somebody gets hurt or dies, that's another big issue. That's the stuff that drives value, and that's the stuff we talk about with companies. External forces. Rating agencies are ubiquitous. They exist everywhere now. What are they? So how you have a credit card, you have a credit score, and it puts you in a number if you are a good, if you're a good corporate citizen to actually use your credit card and pay your debt. That's exactly what these rating agencies are doing in ESG. They are putting a letter or a number to a company tied to their ESG performance. And if a company has CCC rating, that doesn't look good, especially if your peers have AAA ratings. So it's becoming like a way to compare companies. There are a ton of rating agencies. Each has their own way of monitoring and judging companies. It's a black box way that's not consistent, which is why we'll go into, from the regulatory world, they're looking to standardize this because it's, there's no consistency, so it's hard to fairly judge peers. But we'll get there in a minute. So rating agencies are putting a letter or number on you and saying, you're good, you're bad, investors are saying, wow, this guy told me this company is good, this company is bad, I'm going to put my money towards this good company and this bad company. So what we'll tell our clients is, control the narrative around your story. Someone's going to tell your story, whether it's a rating agency, any kind of like activist environmental groups, whatever it is, somebody's going to be telling your story. You might as well figure out what you're not doing well and start to fix it and make it better for your brand, your reputation, your value. So that's what's happening with rating agencies. Investors are shifting capital to and from companies that are best-in-class actors. And then, of course, communities. If you're not managing the communities in which you work, you would know this very well. Like, if you're not managing it, there can be uprisings. There can be, they can stop operations, which can cost millions of dollars. You need to make sure that you're a good social actor and have that social license to operate. If you're not, that can impact your long-term viability. You have to do the right thing. So between these two, companies cannot choose to not do ESG. You have to do it. There's no opt-out clause. Does that make sense? Okay, this one. I'll pause here for a minute just to, I like an interactive conversation, so if you have like a burning question, feel free to ask away, but at the end I'll have plenty of time as well. Great. So this slide I've had for a while now, but it seems to be a hit in describing what we're talking about. So ESG, environmental social governance, can be broken into categories. It's just a way to look at risk holistically that might have been considered fluffy stuff before, the stuff that is not necessarily tied to your balance sheet or general ledger. It's the stuff that's a little bit harder to quantify. These are examples of categories. You can see I've given this to oil and gas a few times, methane is specifically called out here, but it can go across the board. But actually most of these actually do go across the board. Governance, board diversity, executive compensation, political contributions. That's fascinating for me to talk about, being that I work for a lobbying firm, so I even work with my own company on this. These are all very common ESG, and then Lindsay, who's in here, we were peers, you work on climate change a lot, so there's a lot of crossover into different jobs that come into this field. These are no longer just terms and things that you can put as buzzwords in your CSR report. Now you tie energy efficiency to things like cost and revenue, assets and liabilities, and cost of capital. If you are unable to tie these different indicators to some kind of financial value for your firm, it's probably not financially material, and therefore we would not put it as part of our ESG recommendations for our company. We would say, why don't you look at that later? Let's look at what actually drives your bottom line first. And that's actually what keeps us in the room at companies. I'm 32, and when a 32-year-old is speaking with someone who's 65 in an oil and gas his or her whole life, and I'm like, you should care, their eyes roll back, nobody cares, I get dismissed. So the first thing I come in with is, this is going to change your long-term value and how many investors put money into your firm. Do I have your attention? And then we go from there. It's all about money, unfortunately. It's all about money, and you want to make sure that you're able to tie this value to sustainability indicators. That's why this is important. As you go down, these are the indicators that start to shift if you have best practices linked to ESG indicators. So your ability to pay debt or pay dividends on equity, that changes. You want that to be as positive as possible. Supply and demand, we all know in our generation that the more sustainable and friendly you are, you're actually selling more products now, like Tom's shoes and whatever. You get a bigger market segment if you can really show the market that you're beating out your peers in sustainability practices. So that changes. Your OPEX and CAPEX indicators change. So how much it costs to upkeep major assets will decrease if you're doing it well and have the right indicators tied to it. And then of course your discount rates for our corporate finance students in here. That changes, that's a major deal. So this is ESG in a slide. This is what we do, and this is what the market is discussing when it talks about ESG. There are other groups that, like I said, mix sustainability in with that, but for a genuine ESG program, it's financial materiality. Who heard about the BlackRock and State Street? This is what they're talking about. It's this. If companies are not doing this, BlackRock is going to be divesting or not allocating capital towards those companies. Well, they say they're not going to be doing it. Which, there's value to that. They want to make sure the risk is managed. So this is what we're talking about. How are we doing? Yeah.
How do you tie something like that's the thing that I always wonder. Something that that might raise your cost into this, like something like employee health and safety. Mm-hmm. You might need to raise your costs to ensure that happens?
Sure.
And how do you convince the CEOs that it's worth doing that?
That's a great question, and the answer is the margin of that change is minimal to do it upfront and proactively control what the risk is than it would be to have a major downside risk happen.
Okay.
So kind of like insurance, right? You just kind of pay up front and make sure that you're managing your risk proactively. So for example, I apologize for sticking in energy, but ask me any sector, we can go there. But for oil and gas, I use this in when I was graduating here, I did this example. For oil and gas, in the Permian Basin, it's getting hotter and there's less water available. So to implement a water management program, that takes money. You have to figure out where is the water going, who's using what, are my assets and infrastructure up to par to make sure I'm using it. That takes time and money to figure it out. However, if it's a hot year and every operating unit in the Permian has less access to water, one of two things is going to happen. Either you're going to have to pay more money to get access to the same amount of water, or you just don't get the same amount of water, and therefore you get less commodity out of the ground to sell on the market later. Either way, you've tremendously impacted your bottom line by not more efficiently using that resource. So let's say $1.5 million it costs to get a consulting firm in there and to look at your end-to-end and give a statement to the CEO is a whole lot less than the $1 billion over 5 years it can lose in any kind of pricing mechanism selling on the market. It's just a fraction. Mm-hmm.
I can imagine in the environmental there are, in effect, national averages by sectors such that the investor can compare company X against those. I'm trying to figure out what have you got on the social side that is equivalent, that can be used for comparison of company A to company B. What kind of statistics are out there?
In social,
Yeah.
that's one of the more difficult categories to measure. So that's a great question. What we find though is that in this category, what's really important is peer comparisons about what your peer groups are doing, because it is very difficult to measure, for example, employee health and safety. There's rates about, for example, what mining companies' health and safety standards should look like. You want to be compared to your peer group. What health and safety looks like in mining is very different than what health and safety looks like in defense and all that stuff. And so the best way that they can do that now is peer comparisons. There are recommendations, of course. There are frameworks out there. This is, Professor Gardner has all the frameworks for the extractive industries about what social aspects play into it, which will help inform at least a bottom best practice. But in terms of what your peer group is doing, that can lift it up a notch.
What do you do about the next three? Human rights, community relations, and workplace equality.
I'll take that.
Yeah, you should. This is the human rights expert in the room, yeah.
So I was just saying, to look at as you're saying, peer comparables are very important for investors. I'm working with a major investment group now on exactly these issues. And the Global Reporting Initiative, the GRI, I don't know if many of you have had time to study that. But it's really meticulous, and they really, every company has to report, what their carbon footprint is, what their water footprint is, how many people have been hurt on the job, how many people died on the job. These are all risk. This is all risk. And then, as Alana alluded to, we spent a lot of time in the business human rights class that I teach on the free prior informed consent. That community relations piece is the toughest to really quantify, but it is huge, because if a mining company, for example, barrels in and says, okay, indigenous people, get off the land, the head of the government told us, or this one Indian tribe told us it is fine, you go in, put in, mining is very expensive, as you know, extractive industry is not just a little, investments, could be in the billions. One protest every day, a protest could cost $1 million in terms of shutdown of your mine. That's a huge risk. It's under the social, but that's a major risk, which is very quantifiable.
Right.
And so you're also seeing that companies like Newmont, that has changed their board, by the way, lots of women on their board, really excellent women on their board, who go and, with their board, go and meet the communities.
Right.
And the risk has gone down for certain of these companies, but it is in the peer comparables that you just can't compare apples and oranges. these issues.
How would you go about quantifying reputational damage? That came up from time to time in corporate finance, but we never really delved into it. And how does that differ from industry to industry?
That's a great question. So usually reputational damage is assessed with lost business and sales because of some major event from happening, right? That tends to be how this is tied to the ESG space. So reputation, well, it can also work in the positive as well, if you think. So if a company has a great reputation, they're able to secure X amount more sales than a peer, you could probably attribute that to some of what their reputation is, amongst other factors, if you were to isolate it. But it's downside risk that's that major reputational factor. So, you know, with that Uber, when Uber had that major hit go down, or when the BP oil spill that you talked about in your class, Professor Gardner, any other, or when United, you know, dragged someone off the plane and then their stock took a hit, like that's a reputational damage. And then what you're doing, and actually, next slide. Oh wait, wrong one. No, it's not. Is it the one after that? No, I'll get to it though. But what I'll show you is the communications is building an ESG program that's credible is fundamental, I'll show you, but communicating that change is equally as fundamental, and that ties into the reputation piece of it. Does that make sense?
Yeah.
Okay. I'll keep moving along because I want to make sure I have time for questions. So I keep this slide here just to show you that the connection between a company's sustainability performance and financial statements is moving into this concept of a 10K. That's a public company term. That's how companies report to the SEC about, you know, any kind what their projections are for long-term value, risks to the company. It's what, if you're a public company, you have to put this report out every year. And the trend is starting to move that ESG is most likely one day going to somehow be required by the SEC in 10K. It is not there yet, it is not mandatory, but that is where the market trends are moving. And this conversation is happening on the Hill right now, probably today, in the House Finance Committee. They're probably talking about it right now. Because it is there is an inextricable link between sustainability and financial outperformance, so why wouldn't you put that in a 10K if it informs investors? And if there is a substantial likelihood that the disclosure of an omitted fact would have been viewed as important by an investor, whether it's, you know, a typical, you know, operational fact or an ESG fact, if that would have informed my opinion of investing, I should know as an investor. And so they're thinking that this is most likely going to be moved into that space. So here is, I have mixed emotions about this. It's a little complicated, but I want to show you how we kind of do this from a consulting perspective in a not beautiful form at all. This is just an image, but you can see step one, how do you determine what's material for a company, right? So there's all these different topics in the markets that you can consider. What are your stakeholders asking you to do as a company? What is just typical business norms, and what are your peers doing? These are just framework terms, ignore it. It's just there are specific frameworks in the market right now to identify what companies should be thinking about from an ESG perspective. So you take the universe of ESG topics, that's a lot. There's a lot of things that fall into environmental social governance. What drives the most financial impact? You figure out what's important to stakeholders, investors, you know, anybody in the firm, your CEO, your legal team, your accounting team. Figure out who your stakeholders are, get a cross-functional team together and say, listen, these are ESG metrics. Are these important to you? And start to rate and rank them for this firm. Significance of impact. Could not having a water management plan sink an oil and gas company in the Permian? Yes, it can. So that goes into significant of impact. You care about that stuff. You map these out, you do a quantitative assessment on it, and then you start to figure out what is material. And then you should, in theory, have 10 to 15 categories, topics of metrics in GHG emissions, human rights, water management, definitely climate change, governance. Those topics should be considered. And then, I know this is hard to see, but essentially what you get is a mapping of which topics fall where, who is it important to, and what can you start with to get an ESG project done. So that's the materiality part. It's not the best, but it gives you an idea of how we do it. And then what I like to show here is, I remember saying if a company doesn't tell its ESG story, someone else is going to. We live in an age where anybody can post anything about whatever they want. You might as well make the information credible if it's your company, because you really can say a lot of different things, and you want to make sure that if it's your company, you get credit for what you're doing well. Some companies have phenomenal programs in place, and they just don't tell anybody about it. They just do it because it's They need to be doing it, but they're not getting it out to the market. So tell your story. Rating agencies are looking for that information, and everybody else is too. Just because you're oil and gas, this is an example, does not mean you can't be ESG compliant and ESG friendly. In fact, investors are dying to find oil and gas, chemical companies, whatever, that are more intensive on the environment, who have actually managed these risks because they're already integrated into so many types of investment portfolios. It would be nice to know that what you're invested in not only diversifies your portfolio, but they actually are doing the right things from an ESG perspective. And if they're not, they will be more than happy to substitute, not that I'm saying that these are the companies, but to substitute BP for Shell, Chevron for Exxon. They're happy to do it if one of them is a better ESG actor than another. So you might as well do it because everybody else is. And this just gives you examples of how you tie financial value to what a company's bottom line is. So for example, if you have occupational health and safety, if somebody dies on the job, that is tied to fines, litigation claims, whatever, it adds up, and that impacts your revenue. You have to write that down and explain to investors why you spent $10 million on legal fees and whatever because someone died and they weren't wearing the right gear or whatever that day. That's how you start to tie financial value to it.
Specifically, why do investors prefer companies that have stronger ESG practices?
Yeah, it's a great question. So you're managing risk holistically. So investors have to look at companies through the lens of risk, right? If you're investing in a company that's higher risk, you want to be rewarded for that high risk because there's a likelihood that that company might not return on your investment, right? So the riskier you are, there's a premium for that investment. So investors are interested in understanding what a company's holistic risk is. And ESG was initially left out. It was the fluffy stuff, that was the feel-good sustainability stuff before that wasn't really considered. And now they're starting to see that it's not fluffy at all. In fact, this is the stuff that drives the long-term value. And for the companies that do this, these are the ones that are empirically shown to have long-term value, the ones that will outlast their peers because they've considered certain metrics that drive that value, and they care about that. Some investors don't care. They want the riskier companies who don't necessarily have ESG programs. Some investors are actively looking for companies that don't have great ESG standards because those are the ones with more opportunity to build into it, which that means you can find that alpha value because they're moving in the right direction, and so there's opportunity to capture on that delta. So there's all sorts of ways to play it, but in the end, it's a risk management game.
Like financial risk, environmental risk, both?
You tie financial risk to environmental metrics, social metrics, governance metrics. So yes, to your question, it is tying climate change to finance, health and safety to finance. Does that make sense?
Yes.
Yeah. Yeah.
Yeah, I just come back from a trek to New York. We went to Black Rock and talked with people. They say it's like they are doing ESG projects, but they have really low expectation on the returns. And also the capital of the company also talk about the low returns on these projects. So on this term, they won't suggest their clients to do this, to like you say, to have more opportunities to have more high returns. So in this case, how can you persuade your these companies to into ESG or more?
That is the number one question I get ever. So thank you for asking, because I would have brought it up anyway if someone hadn't asked. What we experience in the ESG realm is because there is no standardization, companies can do what they want to do to implement ESG. There is no definition to say you have to hit X% of ESG reporting before you're ESG compliant. So if you were to implement an ESG product or ESG investment strategy and not do your own proper due diligence as to what companies you were bringing into your portfolio, you could very well be investing in companies that are going to be skewing the returns, right? So for example, there was an oil and gas company I just found out that has an ESG statement that has absolutely no ESG anything behind it. It's just words. They haven't done it. So what's happened is the financial performance of that company has skewed the portfolio in general, and they're not getting as high of a return because that company isn't doing it. So the concept of greenwashing impacts that a lot. The other side of this is you have to look at the long-term value as well. ESG is not a quarter-by-quarter investment strategy, so if you're like a hedge fund or private equity where you're looking to turn it around right away, you have to be a little bit more patient before you start to see those returns coming out. And so it might not be the right investment strategy if you're looking to do it immediately. That being said, I have a slide that shows how private equity is mandating ESG inclusion now because of the fact that it has that financial outperformance, and they don't even really care that it's not necessarily a quarter by quarter value. It's a long-term game to make sure that nobody's a bad apple in that portfolio. So some strategies are not going to be, outperformers. It depends on the type of portfolio. Some portfolios are more impact oriented. Some just care about making a difference from an environmental perspective, don't really look at returns as much, and other ones are looking for that highest alpha, highest return. And you might, like I said, because there's no standardization, you're kind of playing now with terms as to how you get that return. But nonetheless, for the ones, there are study after study, I have things coming across my newsfeed all the time about, there's ESG indices benchmarked against market indices, and the ESG indices more often than not perform equally as well, if not better, than the index. So it's just kind of how it is. And just like anything, it remains to be seen of who's kind of greenwashing and kind of ruining the trend. But not everything, it's an investment world. There's other things that can happen.
Sure.
Mm-hmm.
There is one firm which is also private equity firm, but they are also doing greenfield projects.
Right.
So arguing, yes.
Mm-hmm.
Yeah, they're doing that. A
Yeah.
lot of new power plants on renewables.
Right. One of our clients is a midstream. So midstream is the infrastructure in oil and gas to get gas from the production to the end, and they're being forced by their private equity partner to do this. They have a choice. Their private equity partner is saying, do this or get out. And so they're doing an ESG program now because they're going to get dropped if they don't do it. So, wait, wrong one. Okay. And there it is. Private companies. So this was a public market trend. Big SEC mandated companies were doing this just because of what investors are looking for, have to report it out. But now we're seeing private companies, private equity doing this. It is growing tremendously. In fact, our phone rings a lot more now because of privately owned firms than public, which is fascinating because they're not on the market as much. The capital markets is not nearly as clear of a signal as it is. Switch that. Public markets are more clear, this is not, but they see the value of ESG from its risk management, its financial outperformance. They're doing it for that reason alone. And so a lot of words on this slide. It's essentially to say it impacts your growth rates, your assets, and your brand, and that makes all the difference in how you create a portfolio. And that's what's happening in private markets right now. I don't know if I'm missing to mention anything. Oh, I do want to say, because this goes to the slide I was talking about with you, is effective communication storytelling is everything. And that goes to this slide that I gave it the Reuters event in San Diego. We built this because we were trying to figure out how to explain this. This goes into that ROI of what I promised you guys I'd be talking about. I'm doing okay. So ESG in the middle, that's what we were just talking about. You have to create a program to manage your risk. You can't just say you're doing it, you have to do it. Figure out what your company is doing well, get credit for it. Figure out what it's not doing well, fix it. And that's what drives the value. That's the center. You cannot get corporate value, regulatory value, or even the social environmental value unless you tell everybody what you're doing and you make it a way that's accessible. So for social environmental value, if you have, in the topic of human rights, a grievance mechanism program in place to ensure that the communities in which you're operating have a voice. If something scares them, if something is of a concern, if they don't know that you have that, there can be a major issue that happens and nobody knows to utilize it, that'll stop operations. You might have it, they just don't know to use it. So you have to, we call this the moat. You cannot get to this unless you communicate something effectively. It just doesn't happen. It's equally as important. You also cannot do this without that. That's greenwashing, and people see right through it, and you don't want that to happen either. So the corporate value, we've talked about to death now. The social environmental value are the obvious values of making sure you're not leaking methane into the atmosphere, you're not infringing on human rights, you're using water effectively. Regulatory value is the interesting piece of why a lobbying firm has brought me in to do ESG work. It's actually pretty compelling stuff. This slide, before I get into regulatory, is meant to show you just some examples of the entities out there that are requiring that companies tell their own story because they're happy to tell it on their behalf. These are the groups that are creating numbers, letters, and tying it to companies and saying, this is how we think you're doing. This is a snapshot. It's like 8 times the size of the groups that are participating in this. And you can see that's only to 2017, we're 3 years behind, but you can see the amount of reported information has like doubled essentially, with companies just volunteering to put information out to market because they know these guys are gonna say something, you might as well report it out yourself. And so that, the red on that would be even greater than it is today, but it gives you an idea of what's driving this.
I think this group of companies that you just have up there explains a little bit, but
Yeah.
we found that the communications differs dramatically from a public company to a private company.
Public companies have more information on the market that's available, so whether it be a corporate social responsibility report, whether it be 10Ks, whether it be a climate report, aligned to TCFD, it is different in what these companies are able to report, and they do focus on public companies versus private, because private, it's harder to find that information. What's driving private market buy-in is those investors like Blackstone, BlackRock, State Street. They're the ones pushing it. What's pushing public companies are, the public arena. Does that answer your question? Yeah, so that's the difference. It's different angles, but it's still the same pressure. So that's the external agency reporting framework side of it. And what this is meant to show you is how, if you are doing ESG and you're reporting it fairly and you're not greenwashing, access to capital changes dramatically. So this is inflows on the bottom right. Inflows to sustainable funds hit a record high. So if you have an ESG program and you're doing it very well, you need to communicate that out to the market, because you could very well be brought into an investment universe that you were excluded from before. And you could be brought into more types of ETFs, different types of equity investments, or even debt and bonds. This part, the debt and bond side of it, is increasing as well. You can't see this, I'm sorry, but it says green bonds, other ESG bonds, green loans, ESG linked loans. So this is not just an equities market thing, this is also happening in debt markets. And that's what's happening with these ESG programs. And then I want to make sure I get to the regulatory piece, because this is what my firm does, and I have to give them a shout out, otherwise they'd be like, what happened? So where is ESG headed? So as we discussed, this is public market driven stuff. This is not mandated by anybody. This is all just reputation stuff, rating agencies saying you should do it, investors saying you should do it. So companies are forced to respond. What's interesting is that it's now made its way to the Hill, because the value has been proven time and time again empirically. If you do ESG and you do it well, it is linked to long-term financial value. So now people in Congress are saying, that's interesting, maybe we should require this. Because if it really does drive financial value, why wouldn't we require it? As we require many other things that companies have to do, we should probably get our foot in the door and create some kind of standardization, because there are frameworks and guidelines to implement ESG, but there's no one way to do it. There's many frameworks and guidelines. So now what they're saying is maybe we need to go ahead and create a standard, so it's easier for investors to compare. If you put greenhouse gas emissions as X, you can compare it to this company's X instead of being Y. Does that make sense? So that's what we're talking about. So July, the House Financial Services Committee held a hearing on if it should be mandated and overseen by the SEC. I think there were 5 bills tied to that. One of them has passed the House Financial Services Committee, which is this one. September is that committee passed the ESG Disclosure Simplification Act, which is essentially saying make it easier for investors to see what the comparison is between companies. That hasn't passed like the House and Senate yet, of course, and we don't expect that will happen in this administration. But the important thing to note is the conversation's happening. So that's pricked the ears of a government relations firm, because now our clients are saying, well, what if this does become mandated? What would I have to do to go ahead and abide by these types of regulations? How do we do it? So what we do is a lot of education. This is what ESG is. This is how you should think about it. This is how it applies to you. We want to give them a voice in this so that you can have a say into what this might mean for you, because essentially best practices are usually what inform regulation. They want experts to help shape what regulation looks like. They'll come to the market and talk to companies before regulation is made. So we want clients to be aware of how ESG impacts them, so they can have a voice and have a say into what might change and be different. What's also interesting about, lobbying has gone up too. I know this is hard to see, but you can certainly see the trend is lobbying on ESG has gone up tremendously. Now companies know that it's important, they want to go ahead and put their voice in the realm. Here's what I think is interesting. I took the slide out, but I was going to talk about it. I think politics has a major role to play in this in the next cycle. Here's why I think that. Because when ESG is, I call it the centrist language, it's language of money and capitalism. That's interesting from both sides. We don't have to go ahead and go like crazy left or crazy right to have that discussion. That's right in the middle. That's just money. That's how companies operate. It's how our society operates. Centrist. So if you have somebody who's running for governor or somebody who's running for president, and they say, listen, I am a sustainability friendly candidate, and here's why. I believe you should build a renewable farm in wherever, North Dakota, because it'll help with green energy, and I support that. There's no carbon tied to it. We're helping with climate change. I also believe that we should have a pipeline of natural gas because that is a low-cost energy source right now, and we can go ahead and get residents of North Dakota cheap electricity so that they don't have to spend 30% of their paycheck on electricity bills. Aren't I an interesting candidate that I can talk about things for both parties who want to hear the natural gas oil argument and want to hear the wind and green and renewable stuff? And we're going to start to see that. That's my prediction. That's going to start to hit the political rhetoric much more into how you can start to balance these things. Because they're not wrong, but I would be willing to bet they spin it to make it compelling stuff and to get more of the centrist community understanding of what this means. That is the prediction we have, and so these are conversations that are ongoing. Yeah?
I have a big question. Okay.
Ask away, Professor Gardner.
It's fascinating that in this parallel world here, all of this is happening on the Hill now. Because in 2016-17, you might have been following what's happened in the House Appropriations Committee in a different Congress, the whole idea of actually ending shareholder resolutions as we know it. Okay.
Yep.
And February 3rd was the cutoff date at the SEC for a change in the proposed rules, which would make it very difficult for small shareholders to create shareholder resolutions for proxy votes.
Right.
And this would basically put the kibosh on ESG shareholder resolutions as we know it. Okay, February 3rd.
Mm-hmm.
And it may happen that the SEC may actually vote to change these proposed rules now in the opposite direction of what you are.
In the opposite.
In the totally opposite direction.
Mm-hmm.
This has taken 3 years. I was going through the Hill with one of these, what I love, these feisty nuns, Sister Pat Daly, going to the head of the House Appropriations Committee, Rodney Frolinghauser, who thank God is no longer there, from New Jersey 11th. But that meandered through committee and finally found itself at the SEC, and these proposed rules are very dangerous. And now the entire ESG community is waiting with bated breath for the next few weeks to find out what's going to be decided, because one of the parts that you didn't talk about was what these companies are doing in terms of shareholder resolutions and how they vote their proxies.
Yeah.
And the next few months will be critical to see whether BlackRock is basically talking and doing lots of great greenwashing, but actually not doing a thing. So everyone's watching. There's nothing like a vote to sort of make you sort of show your stripes. And so we'll know whether they plan to use the heft of a company like that to support some of these ESG resolutions. So watch for that, everybody, because that is really going to be catching them out. And they did not, BlackRock did not come in and weigh in on this proposed shareholder resolution change, which if they really cared, would have said, no, this is working perfectly. Why change something that works?
Yep.
So
that's a great point.
What is going on here? Because you see this going on the Hill.
Oh yeah.
And what is actually maybe impacting ESG in the next few months.
Yeah, and that's a great point. So does everybody know what a shareholder resolution is?
Not everyone may.
So essentially, if you own part of a company through equity, you have a voice as a voter. Like, you own part of it, so you have a voice to say how the company, what the direction of the company is. And what's happening right now, as Professor Gardner was alluding to, is if you have, what they're saying is they're trying to change the thresholds now for who is allowed to
Durability,
file,
yeah.
who is allowed to have their voice matter in shareholder meetings for a company. So, for example, if I own part of Exxon, which I'm sure, you know, if you guys have money in a 401k, I'm sure everybody's a little bit invested in Exxon, but if you have a voice, if you have money invested in Exxon, you know, as a shareholder, you should be allowed to put forth a shareholder resolution saying you need to write a report about climate change. I as a investor should know. What Professor Gardner is talking about is they're trying to say you have to own X amount % of stock before you're allowed to say anything. You have to own it for X amount of time before you're allowed to say anything. And it's supposed to stifle how many voices are allowed to make those initiatives come to market. So the answer is, I have no idea how that's going to turn out. And what's fascinating to me is by everything that goes on the Hill and just really private sector, public sector is just competing things, because it's the same group on the House Service Financial Committee who's trying to get the SEC to provide more oversight, while this other thing is going on to say we don't want to worry about having to manage all of these different shareholder regulations and policies, so let's go the other direction. So once again, it's a mess, and everybody has a voice as to opposite competing directions. What is fascinating though is because this was in private markets, public, okay, I'm going to use the word public for government right now, not public companies, but public as in government. This came from the private sector. This is driven by companies wanting to report what they want to report. So we're hopeful that that'll keep the trends going, that enough companies will say we, you know, appreciate the voice of our shareholders. Maybe there's a way to manage. They're trying to manage how many proxy votes and shareholder resolutions come in, and does it matter to the majority of shareholders? Does it matter to this 1%? They're trying to manage those types of conflicting things. But yeah, it's a fascinating, I'm glad to hear that you've actually started to stomp on the Hill a little bit. Yeah.
Well, the entire social responsible investor community has been doing that. The problem is they didn't get the big BlackRocks, the Vanguards, and the Fidelities doing it. And so clearly, people who are listening think that it's only these sort of used to be fringe groups, when it actually impacts all of them. So if BlackRock really wants to be a player in this new space, they got to use their heft to show that this is not just the environmentalist, social responsible investors doing it, but these are ESG goes to risk of all these companies, and it hits the bottom line. And until that happens, nothing is really going to change. Right now, we're seeing a very serious slip.
Yep, that's true. That's absolutely true. That's a great point. Shareholder resolutions is a major piece of this.
What's the proposed percentage change for shareholder resolution?
Well, there's a lot of discussion. It used to be you had to have something like $3,000 worth of stock over a number of 3 or 4 years. There was a proposal that had to be like 1% of the stock, which would be basically, BlackRock and maybe Facebook and some things, some of the bigger individual players, etc. They're trying to find some happy medium, but it would basically erase the voice of smaller investors, which means less transparency. And if you care about Main Street as opposed to just hearing from Wall Street big ones, it's very anti-democratic. So this is why everyone's very angry.
Yeah, that's true.
Can I ask another question?
Go for it, yeah.
It's
all Q&A now, like I was in my slides.
But since you're lobbying, this is like where you could you could make a big difference. So when we were on the Hill, and all of this is interesting because people at the EPA and all these people working on these very issues are invested in a government pension fund, right? So then we've been also the U.S. Social Investment Forum, the U.S. SIF, has been pushing to get an option, an ESG option for government pension funds, right? So are you guys going to be lobbying on that? Because that's a huge opportunity.
The ERISA stuff?
Well, ERISA, but it's more than that. It's like, if all of these wonderful people working at the EPA who care presumably, up until recently, about the environment, right? For their pension funds to be invested in the Exxon Mobils and some of the more egregious players is sort of a terrible thing for them, right? So there's been some push on the Hill to say, why don't we get the government pension funds to give them an option? You're not gonna, but people could say, I actually want the ESG option as opposed to the regular other options that we have, and that would be huge,
Right, yeah.
huge.
So I can't answer specifically if the firm is lobbying on it because I don't know.
But
Actually,
that would be a wonderful thing for you.
it would be a wonderful thing. I would love to know if they were doing that. I don't actually know if we're lobbying on that. So it's a government relations firm, and I'm on the advisory services side. I'm still
Right.
trying to teach everybody what ESG is and
Right.
move them along their path. But I don't know. I'll ask because I would love to ask. I'm sure somebody would have alerted me at this point, but maybe not. I'll ask. But in general, pension funds are trying to do just that. To give, Ontario Teacher Pension Fund or whatever. Pension funds are really actually looking to bring ESG in for that reason exactly. They want to let, teacher helpers, whatever, figure out what's the best way to get the highest return on their investment without sacrificing returns as a fiduciary. It's your job to make sure teachers can retire. You want impact, but you also want to retire. So, you have to balance that out. But yeah, that's certainly, it's a really good question. I'll have to ask. I don't know.
Alright. So I have a question about the greenwashing that you talked about. So
Mhm.
what about not entirely greenwashing, but some companies, they do actually do ESGs related, especially environment, energy. So I have this specific example of Apple claiming to be, I think, 97% renewable energy. They say they're using, and the question I think is, well, we are not using, because when we charge this, we're not using renewable energy, and but it's not a concern for them, at least in their report, or at least when we rate them for rating agencies. So the investors may say, oh, it's such a good company, but they're ignoring the consumer end of I don't know how you set the boundaries for these.
Great question.
Yeah.
You have hit on one of the biggest topics of debate right now in ESG. So there are 3 things to note. Let's talk about climate change, right? About renewables, because by buying green energy, you're not adding to carbon and methane in the atmosphere, therefore addressing climate change, right? So it's that topic. There's this thing called Scope 1, Scope 2, and Scope 3 emissions. Scope 1 is emissions that are directly related to the production of your product, commodity, whatever, right? Scope 2 is the emissions tied to the electricity, essentially, that turns the lights onto your operations. So whatever emissions are tied to that, generally speaking. Scope 3 is the emissions that are tied to the consumer use of your product. To your question, so the fun little thing that we're dealing with right now is when companies say we want to go ahead and be carbon neutral because we're amazing and we want to be carbon neutral. What does that mean? Do you want to be Scope 1 carbon neutral, or do you want to be Scope 1, 2, and 3 carbon neutral? Because that's a different deal. And then do you want to be carbon neutral with your own operations, or do you want to buy carbon offsets from someone else who's managing a rainforest nonprofit somewhere in Costa Rica and say you're carbon neutral?
They just want the label, that's all they want.
That's right. And so the question becomes, what are you doing to manage your own emissions, or are you doing the exact same thing and then just planting a tree and saying you've offset X amount of emissions? So to your question, that is a major consideration. Apple is doing a great job. There's other ESG metrics tied to Apple, like data security, that's a big one for the tech world, that kind of stuff. But as it pertains to the electricity that feeds our phone batteries, it's most likely created from natural gas or even coal, depending on where you are. Whatever part of the world or country we'll say that you're in, that impacts how electricity is generated and what plugs into our stuff. And so if you are let's say you're Apple and you're in Ohio, I don't think they are, but whatever, a tech company in Ohio, you're most likely getting a lot of your electricity from coal. So no, you're not carbon neutral, and you certainly have a long way to go when you're figuring out how you can go ahead and mitigate what you're buying. Now, these other companies are also doing power purchase agreements for green energy, so they can say, we're buying all of our electricity from a wind farm in Colorado, and that's how we power our power plants and stuff, and those power purchase agreements make a big difference as well. But that's a great question. That is something you have to consider.
This is a tangential question. So, is the ESG standard set in stone, or can we in the future add things to it? Because I'm doing an internship in the food, private equity, food and agriculture sector, and one of the things is food safety, which
Right.
is very important to that business, but it's not quite generalized So
Right.
do you see that, or is anything else that's industry specific but tangentially related to ESG added to these standards?
Another great question. So ESG is a broad term, but actually it's applied to companies by industry. So what a company does in banking and finance for their industry standards is very different than what a company will do in agriculture, is very different than what a company will do in energy, is very different than what a company will do in healthcare. So ESG goes across all of it, and there are even some metrics that are the same, like climate change and emissions, that goes across all industries, and that's all ESG oriented. But for example, data privacy and security is much more relevant for a tech company, and that falls in ESG. That's the S, that's social. Make sure that your stuff isn't put out to market like what Facebook did. Big reputational impact, by the way. That's a tech company thing, whereas S in oil and gas would be making sure nobody falls off a truck in the mine pit type deal. You don't want people to get injured. So it's all ES and G, but the E's and the S's, G's are pretty consistent. E's and S's change by industry.
We're only talking about SASB and materiality, because that's.
Right, and so the concept of, remember the financial materiality we talked about?
Mm-hmm.
There is a framework that's out there called the Sustainable Accounting Standards Board
Mm-hmm.
that exists, and they're the ones that have done this crazy amount of due diligence to make sure that what is deemed financially material actually has been proven so by industry experts, by investors. They've done the work. That is probably going to be the standard that drives where a lot of standards go, just because it is the one tied to financial materiality. But then, as we were talking about before, there are other frameworks like the Task Force on Climate-Related Financial Disclosure, I'm just going to be dropping names, the Global Reporting Index, the Carbon Disclosure Project, or CDP. All these other frameworks exist out there that are ESG-oriented, but they all have different stakeholder groups tied to each framework. So SASB really speaks to investors, GRI speaks to a much more broad global group, Principles for Responsible Investing speaks to other investors and institutional entities. So it kind of depends, but it all falls in different verticals.
That's where I get confused too. Like, say if an industry or a association in one specific industry, they think that this particular thing is important to them,
Right.
but they want to add it to the ESG standards. Who should they contact?
SASB. Sorry.
It's moving in that
It's
direction.
US.
There is no standardized framework right now. It's moving in the direction of SAS, the Sustainable Accounting Standards Board.
Okay.
But in the end, what's important to note is each company has to determine what's financially material for them. So they have recommendations to what a company should consider, but each company operates in different geographies, different assets, so it could be a little bit broader. You have to really look into even potentially other, verticals to see if something applies to you. You don't want to miss something just because you didn't look broad enough either. Mm-hmm.
Yeah. So what he mentioned about the food safety standards, that's ISO 22000, I think. I mean, it has mainly the focus is about food safety, but it's related to occupational health safety, because that is an angle that you can control the food safety. So that's why I think the company use that as, what they do in the ESG area as part of. And ESG standards, I don't think there's a set stone, that there's no set of standards. You can, there are many, different certification scheme that touch upon that area, and the company can use, by obtaining that certification as their proof of their ESG work.
Right.
Yeah.
There's a lot of frameworks, and it's not like one is wrong. It's just there's different stakeholder groups that are interested in the information provided by the different frameworks.
Yeah.
My company does mostly the SASB related, because we're interested in companies looking at the financial aspect of it. We very, very quickly follow up with, please do not limit that as your ESG engagement, because there are other stakeholder groups that you should consider that SASB might not touch, to your point. So it's very flexible, to answer your question. You have to do your due diligence. Like in anything in life, you have to look at it yourself and make sure that you've covered your basis and you've managed your risk holistically.
Thanks for doing this. This is really wonderful. I was curious, and you sort of touched on it in a question about politics on the Hill, but outside of the sort of narrow lane of financial materiality and bottom line risk, a lot of folks, sort of laymen, approach this question of regardless of what you do with your internal sustainability practices, are you a member of the Chamber of Commerce, who until very recently wasn't quite sure climate change was happening?
Yep.
Do you participate in shareholder resolutions? To your point about BlackRock, they've had a very, very bad record on climate change related shareholder resolutions. They haven't been to church in years, and now they're pledging to go every day and twice on Sundays. People are understandably skeptical about whether this is just a like you say, communications effort, whether companies are actually willing to be meaningful political actors, because none of this will really matter if there's paired with significant government action. The problem will grow so severe that, we're headed for what, 3.3 degrees of global warming? So I'm curious how you sort of see that in the long term.
Oh my god, I mean, it's such a good question. You're right, everybody's just kind of acting in what they feel like they can act upon just because it's not mandated. And one of the most interesting exercises that you ask a company, because we put these frameworks, case studies, we put these examples in front of a potential client who's like, I don't know if I want to do this. I'm like, let me ask you a question. Is it more interesting for the government to come up with a regulation that says you have to do it and you have to report it by this date, and if you don't, you are at risk for financial legal penalties and we can even shut you down? Or is it more interesting for you to figure out what is material to you, are you doing it correctly, and does it drive to the overarching frameworks of 2 degrees Celsius or 1.5, depending on who you're talking to? Does it apply to the Sustainable Development Goals? Are you good, corporate actors from an international perspective? And the answer always comes to, we'll do it. Yeah, because they don't want somebody telling them how to do it. It inevitably is going to cost more money because it might not actually reflect the operating nature of the company to report across the board in one manner. That's generalizing. They probably will make it different, by industry. But we're not heading in the right direction because there is so much flexibility. So then it becomes, well, what can you do to pair the two together, to create regulation that drives the mandatory participation while still allowing capital markets to do what they do best and figuring out how to do it at the least cost for the biggest buck, right? We learned that at SICE, right? The economics 101 is regulatory, regulatory mandates are expensive, they're effective, but they're expensive, whereas, private markets can really figure out what drives it best for themselves, right? So we're still heading in the wrong direction, right? We're going in the right direction, but as quickly as we need to be because there's too many options to participate. So I am the believer that there has to be a mix of both. I also am the believer, and this is the opinion according to me, I'm not speaking on behalf of my company, but if there isn't both, then many companies will continue greenwashing, and they'll continue just saying things that sound sexy, but have no bite behind it, and you have to put the fear in them a little bit that something will happen if it doesn't go a certain way, but I also believe that letting companies drive it for the creativity. You want to shoot for the ceiling, not the floor. You want to make sure that your creativity drives what you can do best versus just fulfilling a mandate and checking the box. So I also think that you can hit the 1.5 degrees if you allow companies to be creative in their solutions versus just saying, we reported out on our GHG emissions, we're done. Make them get more creative than that, and usually that's not done through regulation. Usually, sometimes. Does that answer?
Yeah, thank you.
A lot of the company names that we talked about are today like the largest kind of companies right now with small, medium enterprises or corporations that don't have these gigantic checkbooks to work with. What section of ESG do you think is most easily implementable, and then which one do you think has the greatest impact?
Great question. Most easily implementable, I would say, is governance, because they've had to do that anyway for forever. So that's probably the easiest check mark to, make sure that your executive compensation, you have equal compensation between men and women. Easiest is a relative term, but the governance has been done for forever anyway. The social is a very difficult aspect of it, just because it's hard to measure the return. So it's hard to sell a company on what the ROI is, unless you can see there's a pure comparison to the downside. Without a doubt, the number one thing, whether it's the easiest or not, the number one thing companies should be doing is climate change. You just can't not anymore. Everybody's talking about it, it's in every headline. If you're not engaging in climate change, it's embarrassing at this point. You don't have a good reason not to. So it's not necessarily the easiest, but it is by far and away the most important thing. And Lindsay, I'm sure you can attest to that, doing what you do in analytics, is that companies want to know how they can get in that space and make it compelling.
Yeah. I would agree, though, that I think among, I go to a lot of ESG conferences, responsible investor sort of conferences, and I think that governance is perceived as the most effective. And I think it's because of the longer history and longer record, as she says. But, yeah. we know that climate change is going to have a huge impact.
Yeah. It's in every sector. It's on the Hill all the time. So everybody's talking about it. So that's kind of where you have to engage. It's not necessarily easy, but it's the must. Anybody else?
Thanks so much.
Thanks for having me.